We begin with Chapter 9. In this chapter, we will analyze in detail the short put position. The short put position is used when the market outlook is bullish or neutral. The strategy consists of selling a put option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is limited. The most we can make is equal to the premium received multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the strike price minus the premium received multiplied by the number of shares. This occurs if the stock price falls to zero. Although the maximum loss is limited, its value can be very high. So be very careful with this, because with this strategy we are exposed to a loss that can be very large. The break-even point is equal to the strike price of the option minus the premium received. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a losing situation. In contrast, for stock prices higher than the break-even point, we are in a profitable situation. Continuing with the analysis, the amount of initial margin depends on the broker. In some cases, it can be very large. An increase in volatility hurts the position. Time decay helps the position. With respect to exit conditions, to close the position, we must buy the put. If the stock price is higher than the break-even point, we are in a profitable position. Otherwise, we are in a losing position. When we open a short put position, we become the writers of the put option that we are selling. Therefore, as the writers of the option, we assume the obligation to buy shares of an underlying stock at a specific price for a predetermined period of time. When we open a short put position, it is said that we are selling a naked put. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. A blue curve indicates the profits and losses at the time of put sale. As we get closer to put expiration, the curve of profits and losses is like the one shown in green. And finally, at put expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point decreases. Notice how it moves to the left. And as the value of the break-even point decreases, the range of prices for which we are in a profitable situation increases. Therefore, in this case, time decay helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the eBay company. As we can see, on August 19, 2011, the company gave us a clear bullish signal because the stock touched support and was accompanied by an increase in volume and an RSI below 30%. As we said, on Friday, August 19, 2011, eBay gave us a clear bullish signal. In order to take advantage of that, suppose at that time we had decided to sell put options. At the close of that day, eBay was trading at about $27, so we could have sold 10 puts with a strike price of $25 and expiration in September 2011 at a premium of nearly $1. Thus, we would have received $100 per contract, that is, $1,000 overall. In a short put position, we must consider that as we become the writers of the options, we can use time decay in our favor by selling the contracts with the shortest time left to expiration, which are known as front month options. In our case, the front month was September, and the options were expiring in 28 days. We must also consider that a margin of approximately $3,500 would have been required to open the position. This amount depends on the broker. The next day, the stock price started to rise. On August 24, 5 days later, the stock closed at $29 after trading between 28.5 and 29.5 during the session. That can be seen here. We sold the puts on August 19, the day we got the bullish signal, and a few days later, on August 24, the stock closed at $29 after trading between 28.5 and 29.5 during the session. At that time, the premium of the contracts was 30 cents, so the 10 contracts would be worth $300. If we had bought the contracts at that time, we would have made a profit of 70 cents per share, because we had sold at $1. Thus, we would have had a total profit of $700, making a 70% return on investment in only 5 days. After August 24, the stock continued to rise until it reached the price of $31 on August 30, touching the 15-day resistance. It is important to mention that we can close a short put position by buying the options we sold anytime we want. In a short put trade, and in any options strategy, there is no need to wait for the option's expiration to close the position. As we had said, after August 24, the stock continued to rise until it reached the price of $31 on August 30, touching the 15-day resistance. At that time, the premium of the contracts was nearly 10 cents, so the 10 contracts would be worth $100. If we had bought the contracts at that time, we would have made a profit of 90 cents per share, because we had sold at $1. Thus, we would have had a total profit of $900, making a 90% return on investment in only 11 days. Here we can see the numbers of our example. The strategy consisted of selling 10 eBay puts with a strike price of $25 and expiration in September 2011 at $1. Therefore, our investment is equal to 1 multiplied by 100, which is the price of each contract, multiplied by 10, which is the number of contracts sold. That's a total of $1,000. This money is credited to our account. The initial margin depends on the broker. In this case, it would have been about $3,500. The maximum profit we can make is equal to $1,000. That is the entire premium received for the options. If we had bought at 10 cents, we would have made a profit of $900. On the other hand, the maximum loss that we are exposed to is equal to the strike price minus the premium received multiplied by the number of shares. That is $24,000. This occurs if the stock price falls to zero. The break-even point is equal to the strike price minus the premium received. In our case, 25 minus 1, which is equal to $24. Here we can see the order we must enter to open the position. It consists of selling 10 eBay puts with a strike price of $25 and expiration in September 2011. In the side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option to open, to indicate that we want to open a new position. The entered price is $1, and the order type is limit. That is, we want to sell the options at a minimum price of $1. On the other hand, here is an example of the order we must enter to close the position. It consists of buying the 10 eBay puts that we had sold. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option to Close to indicate that we want to close an existing position. The entered price is 10 cents, and the order type is limit. That is, we want to buy the options at a maximum price of 10 cents. Here we ended with the chapter Short Put. In the next chapter, number 10, we will analyze in detail the covered put strategy.